Thanks for tuning into Talking Point. I'm your host, Neeraj Shah, and it requires a special occasion to get a very reticent guest talking. And that's what we're doing today on Talking Point. Anup Maheshwari needs no introduction, joins in right now to give us his sense of how he's looked at, maybe not this Samvat. The last time that I spoke to Anup was many Samvats ago. So how has he looked at the past, and what does that mean for the time ahead? Anup, I didn't mean as a complaint, though you can consider that one too, if that gets you more often on media. But thank you so much for joining in today.
Thanks for having me, Neeraj. This has been long pending, so I apologize for that, but it's great to be on plan.
No, the pleasure is entirely ours. So, Anup, you run a very unique, in a very unique position, a very large, how do I say, investment firm with presence across both the listed equity space and the alt space, and you observe both, I guess. And how do you see risk assets from your prism currently, from now until the next Samvat or the next maybe 24 months, with all that's happening globally, and of course a busy local calendar as well?
Sure, yeah. So just to sort of maybe, I guess, get the viewers up to speed. So 361 Asset Management, formerly IFL, is what we were known as. It's a fairly unique franchise, like you mentioned, with both alternates and listed equity under the same roof. Alternates are basically everything that is private, unlisted, illiquid. And in our case, that largely includes private equity, structured credit, real estate, infrastructure. Those are the pieces that we have in the alternates book. And then we have a listed book. So totally about $8 billion of broad assets under management, roughly half and half between alternates and listed equities. Now, the big growth area, listed equities, of course, we've been seeing what's been going on. I think there's a long runway for growth for listed equities in terms of people's ownership of listed equities, as well as the mutual fund and asset management business. Alternates is actually even more interesting at a global level. Alternates are actually very dominant features of portfolios, unlike in India. People like alternates both at an institutional level and at a individual level, largely because they don't give you the same volatility as listed equities. The challenge with listed equities is you've got a price every day, you've got an NAV, and that tends to play a role somewhere down the road in people's decisions. In alternates, it's relatively simpler because you're locked in for longer periods of time. There's not much you can do anyway, and you don't have a daily NAV. So people find it as a much better, lower volatility option with returns that are reasonably good if you give it to the right manager. It's a very specialized business. So it's interesting. It's a trend globally for alternates to be increasing over time. I think India will see that trend as well. So over the next few years, I wouldn't be surprised to see alternates becoming bigger parts of domestic portfolios. But right now, just in our life cycle, obviously, even the listed world itself is so underpenetrated that even listed equities is something that will keep growing. So we're pretty optimistic. The asset management industry, as you've seen over the past, sort of tends to grow in step functions. There are periods where there's a bit of a lull, when markets aren't going through a great phase, there's a sideways movement of assets for a few years. And then suddenly you go through a phase where, assets ramp up. So we've been seeing this sort of step function growth in asset management generally in India. And I think we're in one of those up steps right now, with the amount of interest in India as well as with the local capital flowing into markets. That's the way it looks like at the moment.
Okay. So this interest into India, now we've seen evidence of that both from global corporations as well as from money managers. Anup, you have a great idea of what global money might be thinking and doing as well, I presume. Pray tell us, because when we talk to the sell side, there is, in equal measure, I hear about how there are a lot of funds which have made applications, are waiting to come into India for the first time as well. There is emergence of ex-China EM funds, and all of that will mean that over the next 3 to 5 years, structurally a lot of a different class of money and more of the same class of money will also flow into India. At the same time, I hear of investors who are balking at the valuations that India is trading at in a fragile geopolitical environment globally, and therefore they want to be risk averse, especially in a high yield environment. To your mind, what is the more likely scenario, and what is it that you gauge from your conversations?
Sure. So obviously come across all sorts of investors. There's some really long-term pension plans, endowment funds. You have short-term investors as well. So they all come in all shapes and sizes. I think the interest is universal pretty much. And India's stars have risen as China's stars have been falling. I think it's a bit of that is helping India as well. The fact that they're moving away from China, that is also benefiting India. There's not much to make a negative case for India, so to speak. I mean, whichever way you look at it, India looks like a pretty interesting place. Lots of good positives. But you're absolutely right. Where everyone sort of stalls a little bit in conversations is on valuations. And very often when we go across to meet investors like this, we have to explain to them, you have to sort of dig a little deeper than just the headline valuation number, because as we can see in our own markets, there are many pockets of overvaluation and undervaluation at the same time. So the statistics that we quote them the most, which is I think very stark, is investing is all about compounding your money over long periods of time, right? That's what investing is. So we actually did this analysis of how many companies in the world have delivered 20% dollar CAGR in appreciation of price over a 20-year period. Okay. And we looked at 4 major markets actually. We looked at the US, China, Japan, then we looked at India. And we looked at the top 500 companies in each of these markets. Now, interestingly, in India, out of the top 500 companies, about 108 companies as of last month end over the last 20 years have delivered 20% dollar CAGR, 108 out of 500. The same number in the US out of the S&P 500 is 19 companies only. In China, just 13 companies, and in Japan, it's 0.
Wow.
So that just gives you a sense of the ability of companies in India, or at least what they've demonstrated, to scale over long periods of time with the right economics and therefore create shareholder value. And it's not that India was not expensive through the last 20 years. There have been many points at which India has been expensive. So the fact is, it's still a very bottom-up market. If you find the right companies and you can make sure that you're not buying them, ridiculously expensive, there are enough opportunities that are still there to invest. So that's how we try and explain it. That don't just get stuck at the headline number. Even the headline number, by the way, is not too bad. We're definitely not at peak valuations compared to some more extreme points of the past. You could argue again, large caps are a lot cheaper compared to, let's say, small caps, which are probably closer to peak valuations. So again, there are differences there. But by and large, for the market as a whole or for the index, it's not as sort of crazy as it sounds. So therefore, you have to nuance the view. You can't just go with that big picture. India is expensive, full stop. There are reasons also. In India's ROE, return on capital employed, has been higher than other markets. Therefore, it deserves some premium. But anyway, the summary of all of this is what we tell everyone is, listen, things are never as good or as bad as they seem to be at any point in time. India is a great long-term story. There's a lot of scale that's still available. It's one of the few economies where you're getting growth, you're getting strong leadership, and it's all coming together. And to that extent, it's a great long-term market to invest in.
Okay, Anup, I would love to get into the mind of Anup Maheshwari and team and trying to think about, with the presumption that let's assume you are also trying to figure out what possibly could be those list of companies that are going to give a 20% CAGR over the next 20 years. It's not just about this Samvat. It might be a good place to start, which is this Samvat, but you're possibly looking at companies which can give longer term dollar or INR returns, as the case may be. I'm trying to understand what are the precedents or the conditions that are necessary. One, on the numerical side, and two, on the enablers for the themes that might be in place. So please tell us, how are you going about looking at that prism to either validate the existing investments that you guys have, or trying to look for fresh opportunities as more investors put in money into your funds?
Sure. So, a good starting point is what did well over the last 20 years, right? What types of businesses, sectors have ended up creating these sort of 20% compounders. And it's really interesting, again, there, as you dig deeper into those numbers or those companies, it's a fairly wide assortment. We found actually, oddly enough, a fair number of industrial companies there. We were not expecting industrials a large number of industrial companies in that space. Our normal conventional thought was you have financials, tech, pharma, consumer, which are typically what we look at. And they are there. So we do see those names. But industrials was also an element of it. So it's been a fairly wide range, a fair number of small caps, which are still small caps today, by the way, or maybe mid caps now, but have actually delivered 20% compounding over a long period of time. So there's that as well. In terms of the ingredients, typically, what really helps is if you're buying businesses with a decent return on capital capability, let's say 15 to 20% return on capital or return on equity or more, but you're able to buy them at a fairly reasonable valuation. If you're buying them at 50 multiple, it's unlikely that you'll make a 20% compounding. It's when you're buying them at slightly cheaper, maybe a good business going through a bad time, or just a small, sectors go through their own mini cycles. If you find something in a down cycle, so let's say, for instance, maybe healthcare hasn't done very much for some time. That could be something interesting, or some names would emerge from there, for instance. Or let's say IT last year was struggling, and a lot of interesting ideas came out of that. So the minute you take a sort of 20-year view, I think for us it's really a function of which sectors can scale from where they are today. Financials, clearly, India is still very underpenetrated. It's difficult to imagine India doing well without financials doing well over time. Just to give you sort of some ballpark numbers there, in financials in India, there are two parts of lending. You lend to companies, you lend to individuals or retail. Retail lending, which is now becoming a bigger and bigger part of balance sheets. And just to give you a sense of where is India in that curve, retail lending in India today, retail credit to GDP is still at about in the early 20%. If you compare that to any emerging market, it would be between 30 to 50%. If you compare to developed markets, retail credit to GDP is 50 to 100%. So you could argue that we can still grow retail credit at 15% per annum for this whole decade, and you'd still not be an over-leveraged economy. So there's a lot of scale, and also in financials, what we see is obviously companies have good return on assets, return on equity. You have high-quality franchises that have been built up, so there's no reason why they can't continue to compound over time. The same thing, let's say, works in tech, to some extent in consumer, depending on the valuation, consumer discretionary. So it's a wide assortment, essentially. So you can pick and choose enough names. Like I said, there are 108 out of 500. So there's about 20% of the large names, top 500 names have been able to deliver that compounding. We've got to just see over the next 20 years, if we can find 15 to 20% of these listed names, there will be some opportunities like that will be able to deliver it. And of course, the new sectors emerging, new businesses that are getting listed as well. So yeah, I think there's enough potential, frankly, of scale, and as long as you're doing it at good, reasonable return on capital, and you're not overpaying crazily at the starting point, I think compounding is very much possible.
So on the parameters front, and I'm sure there are lots more that goes into it, but to simplify it, you are still trying to choose companies which are available at a reasonable valuation and having the ability to deliver higher return on capital employed or ROCE starting, or maybe scale ROCEs even higher than where they would be right now. On the numerical front, that seems to be the argument. Okay.
You want rising return on capital businesses, but at a point where they're not already priced for that.
Are you sensing those opportunities right now as well? Because save for financials and maybe private banks, or to an extent, a bunch of other spaces wherein these conditions might be present are not necessarily cheap unless they're going through a down cycle, as you said, maybe healthcare.
Yeah, no, that's right. So it's not, at a market level like this, you're not going to, you have to pick and choose. It's all a function of when we are having this conversation. Let's say in 2020, in the
Sure.
COVID, you could just throw a dart at anything and, you'd make that compounding, right? Because everything was very cheap. Now there's as I said, there's a lot of divergence in the market. There are a number of stocks that are very expensive as well. There are sectors that are, industrials, for instance, as a sector is very expensive. Therefore, the starting point of compounding for a lot of names there will be a little tougher. So you have to pick and choose. But as I said, just these very simple broad parameters of just comfort that the company has the ability, A, to last 20 years, B, has a decent management, return on capital, and you're not typically buying good businesses in slightly rough times is the best way to make that big conglomerate.
Okay. And I don't want to label you, Anup, but just for lack of a better word, for somebody who's conservative, presumably so, in paying top dollar for the kind of investments that he might be putting in, what is it as a set of themes that excite you? I'm not talking about whether you'll go out and buy them today because the valuations might be different. But what are the set of themes that excite you, which you will keep on your radar if the valuations are expensive and buy them maybe later on if the valuations become cheap? What looks like exciting structural stories from here on for the next few years? On the new age themes, I know BFSI would be there, pharma would be there. They've been present for a while. A lot of other things. What excites you?
Yeah, so let me start with a bit of a macro sort of perspective first. So we've been largely a services-driven economy so far. And within that, within services, I would say financials and IT have been dominant parts of driving this financial services growth. In fact, if you look at the BSE 500 companies and you deconstruct the P&L statement, if you look at employee costs in total, 50% of all employee costs of the top 500 companies are accounted for by these two sectors, financials and IT. They make up 50% of employee costs. And therefore, how these two sectors perform over time is going to be very important for the consumption journey of India, because these two sectors also tend to have the younger sort of population involved in them. So financials, as we've established, has a long-term journey ahead of itself. IT is the other sector that becomes very critical in this journey for India.
Services, you mean? Services, you mean? Sorry, just to get that clarity. IT services.
IT services, yeah.
Okay.
IT services are everything related to IT, essentially. It could be even KPOs and business process outsourcing, but broadly that space. So IT, to use that word, again, we've had a slightly awkward 12, 18 months. But going forward, we're seeing, again, activity, deal wins, and at some point they will revert to a higher trajectory of growth. But IT as a sector, Indian IT has managed to evolve quite well through different cycles. They managed it on capital really well. And again, now valuations aren't as crazy as they were maybe 3 years ago, 2 years ago. So IT is going to be important in this journey. Financial services is going to be very important. But I think the key change that has occurred in the last 3 years, I would say, is on the manufacturing side. So while we've been services driven, India's sort of lagged in manufacturing. I think China took the lead on that for many years and decades. And what has happened in the last 3 years is finally pushing manufacturing towards India. And manufacturing is going to be a very critical part of India's growth journey over the next 7 to 10 years. And I think that's where you're going to see a lot of new ideas or serious value creation taking place. And manufacturing is important for India in more ways than one, from a very macro perspective as well. For all our optimism about India, I think the thing that we have to look in the mirror on is the fact that our currency has been depreciating consistently for a long period of time. Now, this real strength of an economy is if you're growing and you have a stable currency, typically. Now, what is the reason for this depreciation? And frankly, just as an aside, I'll just take you back in time. We talk about India versus China quite often. If you go back to 1990, India's GDP per capita and China's GDP per capita was almost similar in the $350, $360 range. Fast forward to today, we are at 2,500. China is at 5 times that. But if you actually assess that gap, a large part of it is just the currency. The Indian rupee was 13 rupees to the dollar in 1990, now 83. The Chinese renminbi was 5 to the dollar in the US, 5 to the dollar in 1990, now 7. So there's been a 400% delta just on the currency itself in terms of per capita GDP. The reason for that is China managed to export and had a current account surplus. India is running a current account deficit for the longest time. Now, this is a very important macro transformation, and that's why manufacturing is so important. Manufacturing, if India gets that cycle right, that can actually plug India's current account deficit. Because services exports is already quite robust for India. We're already doing very well. It's manufacturing exports that we've underperformed. So 1% delta on manufactured exports can sort of address the current account deficit. Then you have a stable currency. It creates a very different virtuous cycle of capital flow. People like to invest in more stable currencies. So, I mean, I would argue that the GDP growth number is not as relevant actually as the current account deficit number. It's okay to grow GDP a little lower. We've got a healthy growth rate anyway, but addressing the current account deficit is probably the stronger effect. And that's where this manufacturing change, I think, will be fairly transformational potentially for India if we get this right, both from a macro and a bottom-up point of view.
Yeah.
So that's the big picture. So I think that's where you'll see opportunities, some in services, and a fair amount of them coming also from manufacturing.
Interesting. Assuming that service exports become stronger and this manufacturing wave helps, we might well move, despite our oil imports, to a point when we might become net current account neutral, if you will. I don't know if you agree or no, but there are some quarters who agree. But then at the same time, there's this expression that for a country which wants to grow and has to grow to ensure that employment doesn't suffer, you rather not be current account neutral but remain current account deficit so that you're investing that in growth. Do you envisage India reaching that point wherein it has the luxury of taking a decision of whether it wants to be on the side X or side Y?
No, I mean, again, people will have different opinions on this. It's my personal opinion, frankly. You'd rather grow the current account surplus because that shows strength of your economy. And it also forces corporates to become more productive. Exporting with a 3% depreciation every year is lazy profits, frankly. I think you've got to learn to be globally competitive. And if you can, move up the chain of value and be able to export, and it's just not cost that's driving your trend, I think that is a much more robust long-term model. So current account surplus is really, that's how big economies emerge, frankly. I mean, you don't end up being a massive economy by running a very large current account deficit. Okay. That's not then you keep getting vulnerable to cycles again and again.
Okay. Now, manufacturing by itself, a very wide bucket, more so now because post the PLI schemes and companies taking that benefit, a lot of newer sectors have emerged. And maybe some cases because of PLI, some cases independent of PLI as well. We heard some fantastic stories, Anup. What has impressed you the most from an investing perspective? Because, I mean, for example, just to clarify what I'm trying to ask you, EMS may be a great sector, but some of the starting valuations are not quite reasonable, and therefore from an investing perspective, some could argue that it's not a great sector for investing right now at the current starting point. So I'm just trying to understand what looks good from a manufacturing perspective, keeping in mind that I'm coming from a prism of how to invest there.
No, so it's a wider range. I mean, EMS is one part of it, and there too, by the way, I mean, you're right, valuations don't look great right now, but please understand that there can be very large scale coming through. So what looks a bit expensive today could end up looking quite cheap if the earnings growth takes care of that. So we have to, sort of make those assessments and understand them better. But besides that, you have exports on autos, on all sorts of components. You have, of course, your standard pharmaceuticals or healthcare. Engineered products. So we're seeing other areas that will start coming up for exports, I think, as time sort of moves on, or even the existing sectors, I think, have to sort of expand their horizon and become more competitive at a global level. So we're already seeing Indian products sort of replacing, I was just reading just yesterday, I think it came on the newspapers, how you're seeing more Indian products on the shelf in the US compared to Chinese products. There's a bit of a delta there in terms of what's happening. So it may not be visible in the short run, but I think these are long-term trends that sort of make themselves more and more prominent over time. So I think it'll be a vast assortment, but it will be largely components, engineered components. EMS is obviously assembled, more assembly. At some point, India should be a net exporter of electronics, not an importer. And then, there'll be a lot of sort of allied areas around that we've already spoken.
Got it. Anup, before we wrap up, last question really, which is, since you run a large alts book as well, what is the emerging trend within this whole, and I'm restricting it to startups or companies in which there is direct equity investment, albeit on the unlisted side. What are the exciting trends emerging there? If you can very quickly tell us that.
Well, there's lots of interesting stuff happening. I think this is one of the good parts of the job here, which is you just get to see what's happening also in the private space. You get to meet these phenomenal entrepreneurs. I think India's bottom line biggest strength is just the entrepreneurial capability of India. It never ceases to amaze me. And I think it's sort of, just like in the West, it's the US that has the highest entrepreneurial talent. I think, India sort of exhibits those characteristics here. And so we keep coming up with companies with all sorts of interesting models, a lot of youngsters doing very interesting things and things, which don't meet your standard frameworks in the listed world. So we've been looking at a whole bunch, right across all the standard consumer tech type of names, lots of interesting things happening in healthcare, in financial services, still in IT. Those are some of the big areas. Anyway, most private market investing also happens in. And right now, we're also seeing a lot of interesting areas on the industrial manufacturing side, even in the private markets. So I think, again, wide assortment, but very interesting business models. I can't sort of pin it on one thing because it's so wide. But all I can say is that some really good talent with very bright ideas and interesting economics and scale. So yeah, and we see companies right from literally Series B, C, all the way to late stage. So some very, very, that gives me a lot of confidence on what's potentially coming to the market at some point in time.
Well, one of these days, maybe we'll do a conversation especially on that. But Anup, such a pleasure talking to you today. I repeat, you should do media more often because it's refreshing to hear your thoughts. Thank you so much for taking the time out today, and to you and your team and family, from all of us here at BQ Prime, a very happy Diwali and a prosperous New Year.
I wish you and your family and all the viewers a very happy Diwali and all the best for the next year.
Thank you so much. And viewers, thank you for tuning into this conversation of Talking Point.
Okay, and to all my friends in India, so personal friends and clients and all the media friends, I wish you a happy Diwali, a very colorful one that will bring you light, peace, and joy to you and to your loved ones. Thank you.